Now we're going to see the introduction of the Maxis, Digi Berhad and also Axiata. So the first one will be the Maxis. Established in 1995 by Ananda Krishnan, Maxis is the Malaysian leading mobile communication provider. It offers a wide range of services including postpaid, prepaid phone, broadband and also voice data. Maxis focuses on the enhancing business potential through the managed services, cyber security, cloud and also IoT solution. The company continuously invests in its network and also infrastructure, boasting the fastest 4G LTE in Malaysia and advancing towards the high-speed fiber and also SG technologies. Coming to see the Digi Berhad. Digi Berhad, a Malaysian mobile service provider and a part of the Telenor Group, began operation in May 1995 with digital GSM 1800 services. In June 2021, Axiata, Telenor and Digi agreed to merge, creating a Celcom Digi Berhad, which was officially renamed on February 27, 2023, with Axiata and Telenor each holding a 33.1% stake. Digi offer a variety of the services, including mobile phone, data and broadband solution, and it known for its commitment to innovation and digital transformation. The company focuses on the digital inclusion by making internet services affordable and accessible, and also emphasizes the sustainability and corporate responsibility, enhancing its reputation in the industry. The next is Axiata Group Berhad, found on June 12, 1992 as Telekom Malaysia International (TM1), was rebranded in March 2009. The company aimed to become a new generation digital champion by 2020, offering a diverse range of mobile, network, communication infrastructure, and also digital services. Axiata owns controlling stakes in 6 mobile operators, which is Celcom in Malaysia, XL in Indonesia, Dialog in Sri Lanka, Robi in Bangladesh, Smart in Cambodia, and NCL in Nepal, along with the strategists holding in Haidia in India and M1 in Singapore. The company manages over 25,000 telecom towers in 5 countries through the infrastructure hub. In 2012, Axiata found Axiata Digi, which has developed 29 digital businesses across mobile money, advertising, e-commerce, entertainment, and also educational sector.
Now, I would like to present about the analysis and comparison of the companies. First, return of equity. The return of equity, Maxis has been declining from 19.45% in 2021 to 18.54% in 2022, and then to 25.14% in 2023, suggesting potential profitability issues. Celcom Digi exhibited an extraordinarily high ROE of 183.64% in 2021, but this dropped significantly to 4.68% in 2022 and 9.52% in 2023, indicating major changes in financial performance. Axiata's ROE was high at 32.66% in 2022, but decreased 0.50% in 2023, reflecting a decline in profitability though still relatively strong compared to industry norms. Next, return on assets. Maxis ROE has declined from 5.83% in 2021 to 5.12% in 2022 and 6.34% in 2023, indicating changes in maintaining assets efficiency. Celcom Digi's ROA was high and stable at 14.91% in 2021 and 2.03% in 2022, but experienced a sharp increase to 4.30% in 2023, showing improved efficiency. However, the drastic drop in 2022 highlights potential issue affecting assets profitability. Axiata's ROA fluctuated increase from 1.76% in 2021 to 12.27% in 2022, and then decreasing to 0.18% in 2023, reflecting changes in maintaining assets profitability. Next, operating profit margin. Maxis operating profit margin declined from 19.07% in 2021 to 14.18% in 2023, showing a slight decrease in operating efficiency and profitability. Celcom Digi's margin fall from 23.91% in 2021 in 17.20% in 2023, indicating reduced efficiency and profitability with a significant drop in 2023, pointing to rising costs on revenue challenges. Axiata's margin increased from 8.39% in 2021 to 40.42% in 2023, then decreased to 3.61% in 2023, reflecting fluctuating operational efficiency and profitability, with the decrease suggesting issue with rising costs or market process. Next, gross profit margin. Maxis gross profit margin declined from 65.22% in 2021 to 62.83% in 2023, indicating reduced efficiency in generating profit over its cost of goods sold. Celcom Digi maintained high and increased gross profit margin from 72.73% in 2021 to 78.65% in 2023, reflecting a strong operational efficiency and effective cost management. Axiata's gross profit margin decreased from 92.05% in 2021 to 83.9.15% in 2023, highlighting challenges in maintaining efficiency and rising costs of competitive pressure. Next, total assets turnover. Maxis maintained a stable total asset turnover ratio, improving slightly from 0.14 in 2021 to 0.45 in 2023, indicating consistent operational efficiency in utilizing assets for sale generation. Celcom Digi experienced a dramatic decline in total assets turnover from 0.81 in 2021 to 0.18 in 2022, followed by a significant recovery to 0.35 in 2023, highlighting fluctuation in asset utilization efficiently. Axiata showed a declining trend in total assets turnover from 0.36 in 2021 to 0.26 in 2023, indicating ongoing challenges in efficiently leveraging assets for sale generations. Next, total liabilities to equity. Maxis increased its total liabilities to equity ratio from 2.34 in 2021 to 2.97 in 2023, indicating a strategic preference for more debt financing potentially increased returns while highlighting financial risk. Celcom Digi significantly reduced its ratio from 11.39 in 2021 to 1.21 in 2023, demonstrating a substantial overhaul in financial strategy with reduced debt level and improved stability. Axiata gradually decreased its ratio from 1.89 in 2021 to 1.78 in 2023, reflecting ongoing efforts to enforce financial stability by reducing reliance on debt and optimizing financial management practices. Next, long-term debt to equity. Maxis experienced fluctuation in its long-term debt to equity ratio, increasing from 1.2 in 2021 to 1.35 in 2023, reflecting varying levels of reliance on long-term debt for strategic purposes. Celcom Digi dramatically reduced its ratio from 6.06 in 2021 to 0.65 in 2023, indicating a strategic shift towards lower long-term debt, improved financial stability. Axiata's ratio gradually increased from 0.99 in 2021 to 0.79 in 2023, highlighting the calculation approach to balancing debt and equity to enhance financial resilience and potential risk. Next, pricing earnings. Maxis experienced fluctuating in PE ratio from 29 in 2021 to 30.28 in 2023, indicating changes in investors' perception and experience about the company's earnings potential and market evaluation. Celcom Digi's PE ratio valued significantly from 29.41 in 2021 to 41.86 in 2022, then to 31.25 in 2023, reflecting violence investors' sentimental and evolving views on the company's future earnings and growth perspectives. This fluctuation highlighted shift in investors' confidence, market conditions, and experience improving the stock valuations. Next, price to book. Maxis experienced a decline in its PB ratio from 24.22 in 2021 to 11.65 in 2023, indicating varying investors' perception of the company's market value relatively to its book value. Celcom Digi similarly saw a decrease from 13.69 in 2021 to 4.39 in 2023, reflecting significant shift in investors' sentiment and valuation. This fluctuation highlighted changes in market perception potentially influenced by reassessment of growth, experience, market correlation, or improvement in book value over the period. Last but not least, dividend payout ratio. Maxis maintained a stable dividend payout ratio around 1.02 in 2021, increased to 1.32 in 2022, and decreased slightly to 1.26 in 2023. Celcom Digi varied widely from 0 in 2021 to 1.30 in 2022, returning to 0 in 2023. Axiata's stated high at 1.07 in 2021 dropped to 0.13 in 2022, significantly decreased to negative 0.146 in 2023, indicating a shift towards retaining more earnings for growth and stability. This reflects strategic adjustment in dividend policies to balance shareholders' return with long-term financial goals and market dynamics.
Identify and compare the strengths and weakness of each category of the company. First one is return on equity. The strength of this is return on equity is a key measure for assessing how profitable a company is in relation to its shareholders' equity. Investors pay close attention to this ratio because it shows how efficiently a company is using their money to generate profits. The second strength is shareholders can use this ratio to evaluate how well management is performing, helping to reduce any potential conflicts of interest between them. The weakness is the ratio is affected by the amount of equity shown on the balance sheet, which can change depending on the company's capital structure and its industry. Second weakness is net income can be influenced by accounting rules, estimates, and other factors controlled by management. Management can also boost this ratio by decreasing equity through share buybacks. Second is return on assets. The strength of return on asset is return on assets helps management analysis and investors determine if a company is effectively using its assets to produce profits. The second strength is return on assets is a financial metric that shows how profitable a company is compared to its total assets. Weakness is a return on asset formula is especially useful for banks and financial institutions because it measures how efficiently they generate profits from their assets. Return on assets is not universally applicable across industries because companies in different sectors possess varying asset bases. The third one is operating profit margin. The first strength of this is expressed for each sale after subtracting variable costs but before including interest on taxes. Second strength is the operating margin shows how efficiently a company turns its core operations into profit. The weakness of this is various industries, each with distinct business models, frequently have notably different operating margins. The second weakness is the operating margin is best applied when comparing companies within the same industry, especially those that share similar business models and yearly sales volumes. After that, gross profit margin. The strength of this is it provides companies with a reference for adjusting prices to optimize their profit. The second strength is the operating margin, a straightforward and useful measure, is easy to figure out and offers insight into how well a company manages costs, its overall financial well-being, and how efficiently it handles direct expenses during a particular time frame. The weakness of this is the gross profit margin is not always the perfect benchmark for comparing industries because cost structures and how profit is calculated can vary widely between different sectors. The second weakness is it doesn't give a full view of how efficiently a company operates because it leaves out indirect costs like salaries, rent, electric bills, and advertising expenses. The next is total assets turnover. The strength of this is investors frequently use total assets turnover to compare different companies before making investment decisions. The second strength is it can be used as a tool to signal asset impairment. A sudden decline in the ratio could suggest that the company's assets are no longer capable of generating income. The weakness of this is net income represented real profit. Even if a company has a high sales relative to its asset, it doesn't guarantee that they are generating profits that benefit shareholders. The second weakness is it's difficult to compare across different industries. Service companies typically require fewer assets, resulting in higher ratios. Total liabilities to equity. The first strength is capital structure. The total liabilities to equity ratio describes the company's capital structure, indicating the proportion funded through borrowed funds versus shareholders' equity. The second strength is financial analysis. To assess a company's financial leverage, this metric divides total liabilities by shareholder equity and is crucial in corporate finance. The weakness of this an ideal ratio is not. The ideal debt to equity ratio of 1:1 does not fit every company. Some business might need more debt to invest in and maintain their assets, which can fuel growth and increase future profits. The second weakness is investors can be missed. For an investor, it's crucial to thoroughly analyze the company from every angle and understand all its aspects. After that, long-term debt to equity. The first strength is long-term planning. With low capital, business owners can maintain control over their operations. The weakness is interest owners have a better chance of taking on more debt in case of urgent financial needs. Next is price to earning. The strength is it allows investors to compare how well stocks from different companies perform, and then it also lets you track how well a company's stock performs over time. The weakness is when comparing, it's important to focus on companies within the same industry. It might be misleading if the net income includes unusual gains or losses. Price to book. The strength is the price to book ratio provides straightforward method to assess a company's valuation relative to its net worth. The second is this ratio tends to be more stable because assets value fluctuated less than earnings. Weakness is the price to book ratio is practically usual primarily for capital intensive companies such as those in the energy, transportation, large scale manufacturing or financial sectors with significant assets on their balance sheets. The second weakness is intangible assets like brand names, goodwill, patents, and other intellectual property are not considered in the book value. The last one is dividend payout ratio. The strength is this metric is vital for understanding how well a business is performing operationally and predicting its potential for growth. Next is the high ratio of these measures shows that management cares about making shareholders happy, providing they are handling things like grown-ups. The weakness is a lower ratio doesn't always signal trouble because the company might be reinvesting profits to ground in the future, aiming for even higher profitability down the road. Before trusting this ratio blindly and investing solely based on it, it's wise to be cautious and analyze the companies a bit first.
We're going to see the justify for the three companies. The first one will be the Maxis shows the stable and improving ROE rising from 19.45% in 2021 to 25.14% in 2023. In contrast, Celcom Digi of ROE is highly volatile, dropping from 183.64% in 2021 to 9.52% in 2023, while Axiata ROE is fluctuate sharply, falling from 32.636% in 2023 to 0.50% in 2023. This indicates the Maxis' strong performance, where Celcom Digi and Axiata face significant profitability issues. Next is Maxis shows the consistent long-term efficiency with an ROA of 5 to 6%, while Celcom Digi ROE is unstable, falling from 14.91% in 2021 to 0.03% in 2022. Before improving to 4.30% in 2023, Axiata ROA is fluctual significant, peaking at 12.27% in 2023 by dropping to 0.18% in 2023. Maxis is the most stable and efficient, whereas the Celcom Digi Axiata face challenges with consistency. Maxis has seen a decline in its operational profit margin from the 19.07% in 2021 to 14.18% in 2023, reflecting decreasing long-term efficiency. Celcom Digi displayed a drop from 23.91% in 2021 to 17.20% in 2023, remains relatively stable and efficient. Axiata faced several fluctuations, with the margin peaking at 40.42% in 2023 but falling to 3.61% in 2023. This indicates significant inefficiency and also instability. This has shown reasonable long-term efficiency with a slight decrease in gross profit margin from 65.25% in 2021 to 62.83% in 2023. Celcom Digi has improved its efficiency significantly, with its margin rising from 72.73% in 2021 to 78.65% in 2023. Axiata maintains a high margin but experienced a gradually decline from 93.05% in 2021 to 89.15% in 2023. This indicating strong but also potentially decreasing efficiency. As demonstrate improved long-term efficiency with a steady increase in total asset turnover from 0.41 in 2021 to 0.45 in 2023. In contrast, Celcom Digi has experienced high volatility, with its turnover dropping from 0.81 in 2021 to 0.18 in 2022 and slightly recovering to 0.35 in 2023. Reflecting a variable efficiency, Axiata show a decline in also long-term efficiency, with asset turnover expected to increase from 0.36 in 2021 to 0.28 in 2022. Next, Maxis has seen a significant increase in its total liability to equity ratio, rising from 2.34 in 2021 to 2.97 in 2023, indicating growing long-term financial risk. In contrast, Celcom Digi has markedly improved its financial stability, with the ratio falling from 11.39 in 2021 to 1.21 in 2023. Axiata maintains stable financial management with a consistent ratio ranging from 1.66 in 2023 to 1.78 in 2023. Overall, the Celcom Digi excel in managing leverage, while the Maxis face increase and challenges, and Axiata performed results. Maxis has increased its long-term debt to the equity ratio from 1.20 in 2021 to 1.55 in 2023, reflecting a growing reliance on debt financing. Conversely, the Celcom Digi has significantly improved its financial stability, reducing the ratio from 6.06 in 2021 to 0.65 in 2023. Axiata has shown consistent and also competent management, with a stable debt to equity ratio ranging the 0.59 in 2021 to 0.79 in 2023. Overall, Celcom Digi Excel is minimized debt reliance. Maxis demonstrate a relatively stable investor interest, with a demonstrate range in price to equity ratio from 29 in 2021 to 30.28 in 2023. Celcom Digi, however, the facing significant instability with its price to equity ratio varying from 29.41 in 2021 to 41.86 in 2023 and back to 31.25 in 2023. Reflecting mixed investor opinion, Axiata show a dramatic fluctuation in its price to equity ratio, ranging from 42.70 in 2021 to 2.99 in 2022 and also negative 12.46 in 2023. This indicating the substantial investors' uncertainty. All three companies show a consistent decline in their price to book ratio, indicating a reduced market valuation relative to their book value over time. Maxis ratio decreased from 24.22 in 2021 to 11.65 in 2023, and Axiata ratio fell from 23.75 to 11.26, both reflecting a gradually decline. Celcom-Digi experienced the steepest from 13.69 in 2021 to 4.39 in 2023, highlighting the greatest loss in the market confidence. Overall, the while Maxis and Axiata show relatively more gradually decrease in the market valuation. Last and not least, Maxis maintained a high and stable dividend payout, reflecting strong efficiency in profit management. Celcom-Digi shows the volatile dividend, indicating the difficulties in consistency, while the Axiata faced several financial issues with the negative payout ratio, signaling insignificant challenges.
Conclusion and recommendation. First point is financial ratios. Financial ratios are vital tools for assessing an organization's financial health. They provide a quick overview of the company's performance and are essential for long-term analysis and comparison with industry peers. Maxis overview. Maxis is the most popular phone network in Malaysia, known for the intensive service offering and strong market presence. Its financial statements indicate a robust financial position and widespread customer preference, making it a lower risk option. Ratio analysis. Ratio analysis helps identify a company's strength and weakness by examining the relationship between different financial metrics. This process provides a meaningful insight into the company's overall financial performance. Recommendations. Regular financial analysis. Conducting regular financial analysis is crucial for identifying and addressing any financial issues promptly. Key financial principles. Understanding and applying core financial principles such as the importance of cash flow and the balance between risk and reward, and the accuracy of market prices are essential for maintaining a strong financial positions. Thank you.